The Fibonacci ratios are a very powerful tool that can help you in identifying and pinpointing market reversals with ease. But like most of the trading indicators, you should never use Fibonacci alone for your trading. I will be going over the complete guide to understanding and applying the Fibonacci ratios for your trading. We'll first understand the basics of Fibonacci, and then we will proceed to advanced trading strategies using the Fibonacci ratios. We need to understand what Fibonacci ratios are. Fibonacci ratios origin from the Fibonacci number series. The Fibonacci numbers were created by an Italian mathematician named Leonardo Pisano. The reason why these numbers are important is because they are seen in various aspects of the universe. Ancient architecture, petals on flowers, the shape of our faces and body, are all in some way associated with Fibonacci. Therefore, the advocates of Fibonacci state that the prices of any assets might also be moving in relation to Fibonacci. If you calculate, you will find that any given number in the Fibonacci series is 1.618 times the previous number. Therefore, the number 1.618 is called as the golden ratio. Now let's understand how we can apply the Fibonacci numbers in our trading. If you have been trading for a while, you will already know that the price of any asset does not move in a straight line. The price always moves in a zigzag fashion. Every time the price makes a huge move, there is always a pullback that follows. As a trader, we want to catch these huge impulsive moves. Therefore, we try to enter a long position at the end of this pullback to capture this huge up move. The problem is how we know that the pullback is over and the price is due for an up move. This is where the Fibonacci retracement tool will help us. When the price is in an uptrend, first we see that it makes a huge up move. Then, we see a small down move. This down move is essentially a pullback. The Fibonacci retracement tool will help us in finding potential areas where the price might find support during this pullback. On the other hand, in a downtrend, we see the price makes a massive down move. Then we see a pullback, which is this up move. The Fibonacci retracement tool will help us in identifying potential areas of resistance where the pullback might come to an end, and the price might start another down move. In most of the charting platforms, you will find a lot of levels on the retracement tools. But most of these levels are useless. Personally, I only use the 38.2, 50, and 61.8 levels. I suggest you to remove all the other levels from your tool. Now, to use the retracement tool, we first need to correctly plot the retracement tool. When the price is in an uptrend, we first need to identify the most recent major swing low on the chart. For instance, on this chart, this is the major swing low. Then we need to identify a major swing high, which is this point. Now, we select the retracement tool and plot it from the low of the swing low to the high of the swing high. We want to make sure that we plot the tool from the low to the high. The three lines that we get in the middle are the Fibonacci retracement levels. They are 38.2, 50, and 61.8% of the entire move. In an uptrend, the price will find support at these levels. As you can see, the price found support exactly at the 61.8 level in this example. Similarly, in a downtrend we will reverse the process. First, we need to identify the recent swing high. On this chart, this is the most recent swing high. Then we will identify the most recent swing low on the chart, which is this point. Now, we will draw the retracement tool starting from the high of the swing high to the low of the swing low. The three lines that we get are the Fibonacci retracement levels. Now, because the price is in a downtrend, we expect the Fibonacci levels to act as a point of resistance. And as you can see, the price found resistance at the 38.2 level and immediately reversed downwards. A pro tip to note here is that, if the price is in a very strong trend, the price will often respect the 38.2% level and will rarely go beyond it. This is because, in a strong directional market, the pullbacks of the trend are very shallow. On the other hand, when the trend starts to mature, the pullback will often find support at 50 and 61.8% levels. In most trends, the price will tend to respect the 50 and 61.8 levels. The 38.2% level will only be used in very strong trends.